people have come around to my view that maybe we're not going to have a recession. The AI revolution is the real deal. All this capital spending is a big boost for economic growth. These companies are basically saying, the managers are saying, boy, we wish we had all that capacity today because we have the demand today. This roaring 2020s idea is all based on the notion that the economy is fundamentally resilient, consumers are fundamentally resilient, capital spending is strong.
We're right in the middle of earnings season. We'll recap that. Tech stocks are rebounding from a big sell-off the prior week. We'll talk about what's next for markets and what's next for bond yields, and who better to talk about bond vigilantes than the man himself who coined the term back in the 80s. Ed Yardeni joins us now. He is the founder and president of Yardeni Research. Welcome back to the show. Dr. Ed, good to see you.
Thank you. My pleasure.
What were you referring to in the 1980s when you coined the term bond vigilantes? Let me play for you a clip of the last FOMC meeting that happened last week. Chairman Warsh was asked a question about why he didn't raise rates last week, and I think he gave a pretty remarkable answer that speaks directly to your work. Take a listen and we'll react together.
So the Fed funds rate is now about 75 basis points below the two-year yield. Suggests markets think you'll have to tighten eventually, about 100 basis points below most Taylor rule estimates. You're hitting your employment mandate, inflation stays high. Why should rates not be higher today?
Rates are higher today than they were 42 days ago. Markets have made decisions because we step back in part from trying to influence those. Market judgments have moved up on what nominal rates are across the Treasury curve. That doesn't mean we take them as by dictation, but we're observing them. So I think it's a mischaracterization to say that markets haven't reacted because we didn't move today. Markets are reacting in real time. Monetary policy matters not just by what we say or even what we do. Monetary policy matters by how it affects the real economy. And these prices that we see in financial markets is one of the many ways in which it affects the real economy.
Okay, who are the bond vigilantes and are they back?
Well, I think in some ways they're back. The bond yield has been around 4.6, 4.7%. I think that's nothing to get particularly concerned about, but the entire yield curve is clearly pricing in a Fed rate hike, or at least it's as the Fed chairman said, the bond market seems to be doing what the Fed should be doing, and the only question is, will the Fed come around and listen to the message of the bond market? And I think in this case, a lot of the messages in the 2-year, just as the reporter from Axios pointed out, the 2-year is basically 3/4 of a percentage point above the current Fed funds rate. It's about a 4.25%. And the Fed funds rate is 75 basis points below that. In effect, the 2-year is saying that the Fed should be reversing the 3 rate cuts that were provided at the end of last year. I didn't think they were necessary, and I think that those rate cuts really just exacerbated the underlying inflation problem. You know, inflation is not 2%; it's closer to 3% by most components of the inflation rate. So, I would say the bond market right now is sort of in suspense, trying to figure out whether Warsh is going to deliver a rate hike in September or not. Meanwhile, the bond vigilantes are doing their thing in places like the UK and Japan, where bond yields have gone up a lot in protest of the lack of vigilance by the fiscal and monetary authorities. And so it's still an issue here, but we're not at a point where the bond vigilantes are really doing anything drastic to the economy.
Well, you coined the term back in the 80s. What exactly were you referring to? Were you talking about a group of people that ultimately want to change in fiscal policy?
No, it's not anybody you can identify. It's the bond market in a broad context. And the bond vigilantes are basically bond investors of all types, individuals, institutional investors who are trying to decide whether bond yields are where they look attractive. In 2023, the bond yield went from 4 to 5% in 3 months, and that was clearly a sign that the bond vigilantes were not happy. We had 3 terrible auctions in which they didn't go well, obviously, and the bond yield soared. But at 5%, a lot of investors thought that was a pretty good yield, and they jumped in and bought. In 1983, when I first coined the phrase bond vigilantes, what I said is that if the fiscal and monetary authorities don't remain vigilant about inflation, and we had a really bad inflation problem in the 70s, then the bond vigilantes will take over. Bond yields will move higher, and that will slow the economy down. And that's actually what happened about 3 times in the 1980s. Bond yields did go up because of concerns that inflation was going to come back, and that the sheriffs weren't doing enough to bring inflation down. And by pushing bond yields up, they actually did lower inflation, and as a result, the bond yield came down.
Before we continue with the video, let's talk about your most important asset, your personal privacy. Now, you've probably never voluntarily handed your personal information to a data broker, but they have it anyway. Your name, home address, phone number, even details about your family are collected and sold to whoever is willing to pay for it. That's why today's sponsor, Delete Me, is a service I use to cut that down. Setup takes a few minutes, and after that, their team does all the work. They find where your information is listed, verify it, and submit removal requests to hundreds of data broker websites around the internet. Then they keep checking because these listings tend to come back. Since June 2024, they've been reviewing my listings, and my most recent report showed 335 listings reviewed last month alone. Scan the QR code here on the screen or go to joindeleteme.com/David Lin, link down below, and use the code David Lin for 20% off. Take back control of your privacy today. Now back to the video. Do you think that's going to continue to happen today?
I think it's a definite possibility. I wouldn't say it's inevitable. Look, my view is that the bond yield is back to normal. To me, 4 to 5% is kind of where it should be. So I'm not particularly stressed out about these levels of interest rates. And I think what I see is that the bond yield range is back to where it was before the great financial crisis, and is also back to where it was before the financial crisis of the 1970s. 4 to 5%, I think, is a rate that the economy can live with. It's a rate that shows that the capital markets are allocating capital appropriately, properly. But I've often said that I'll worry about the bond yield, about the bond vigilantes when the market worries about them. And right now, I think we kind of got everybody excited about the bond vigilantes again when we went up to a little over 4.7% a few days ago. But it's already come down a little bit, and I think it helps that oil prices came down. A lot of people are just waiting for a real doom and gloom scenario. Ray Dalio has been preaching this idea for a long time that there's an imminent debt crisis. But what I've observed is that more often than not, supply and demand is not what drive the bond yield. It's expected inflation, and Fed policy. Yeah. I think the initial reaction to what Warsh said and didn't do, which was to raise the Fed funds rate, was basically a sign from the bond market that he'd failed, that he probably should have raised rates. Because, in April, before he was Fed chair, the Fed was in easy mode. And then when the Fed chair Warsh came in June, he really surprised everybody by being talking hawkish. He said that the number one commitment of the FOMC is to bring price stability. And you would think that having said that the next thing would be, for his credibility's sake, to deliver a rate hike. of 25% basis point, 25 basis points in July, but he didn't. So now everybody's kind of expecting that it'll happen in September. The problem for him is he's getting kind of close to the midterm elections, and President Trump's not going to be too happy if the Fed raises interest rates between now and the midterm elections. So maybe Warsh is kind of crossing his fingers and hopes that the Middle East situation will be calmed down, that oil will come down, and that other inflationary pressures will subside. But I don't think he's going to be that lucky.
You made the statement earlier that 4 to 5% is normal. So the 30-year has been above 5% since May. I believe the 4-year is still below 5%. Some people on Wall Street are calling for this to be a dangerous zone. So HSBC back in May said that if bond yields approach 5%, we're entering the danger zone. That's what they said. Strategists from HSBC called U.S. Treasuries are now firmly in the danger zone. Even further into the danger zone, likely leading to risk assets temporarily lower. This was back in May. Risk assets have grinded sideways, maybe temporarily lower, but then recovered. What assumptions do you think strategists in that particular camp will be making about the debt cost going higher that maybe you're not making?
Well, I think these folks have been probably in this camp for a long time. I have books on the bookshelf behind me going back to the 1980s called Living Beyond Our Means and The Debt Trap and so on. And when I went back and reread recently what I wrote in 1983 when I first coined the phrase bond vigilantes, I wrote that the bond vigilantes back in the early 80s, as we just discussed, were threatening to push bond yields higher if there wasn't more vigilance by the Fed and Treasury to focus on bringing inflation down. And so back then, I wrote that the bond vigilantes are very concerned about $250 billion deficits. Now we're running $1.5 to $2 trillion deficits, and the auctions are going pretty well. As I said, we did have sort of a mini debt crisis in 2023, where the bond yield went from 4 to 5%, and the auctions were sloppy. If that were to happen again, I'd get concerned. But on the other hand, as we saw in 2023, I think when you get a high enough yield, like 5%, you'll see a lot of buyers. And by the way, as I said, the bond market, the bond vigilantes are not the only players. Yeah. The Treasury back in November 1st of 2023 calmed the bond market down basically by saying, well, we need to raise more money, but we're not going to tap the bond market for more than we usually do. We're going to get it in the bill market. And that calmed the bond market pretty dramatically. Scott Bessent, at the time, the Treasury Secretary, opposed it, but now he thinks that's a good idea. And he loved the Genius Act, which legitimized stablecoins, I think it was a year ago. And what that does is stablecoins need to be backed up by Treasury bills. So he's ready, willing, and able to intervene to keep the bond yield going up. And he just intervened in the yen. It's very unusual for Japan and the United States to gang up together to try to bolster the yen. And in our situation, the Treasury Department intervened by buying yen and selling euros. Bessent will do anything he can to avoid a calamity in the bond market. And I think that's the reason he intervened. The Japanese are the largest holders of our treasuries. He didn't want to see them having to sell treasuries to buy yen to support their currency. So again, there's a lot of moving parts here. The other thing I'd point out to David is, as long as the auctions are going well, and somebody's buying that debt, then that debt clearly becomes somebody's asset. And the reason they bought it is because they're doing well, and they want to invest, and they think government bonds are a good asset to have in a portfolio. So everybody on the pessimistic side always looks at debt as a major risk. But then as long as you got buyers that are willing to buy it at a rate like 4 to 5% that the economy can deal with, it's not a problem.
I want to come back to Japan since you brought it up, but this paper that you, or an abstract from a paper that you wrote in 2018, the Bond Vigilantes, examines the relationship between bond yields and nominal GDP growth. I won't read the whole thing, but to summarize, the relationship changed depending on the decade. Can you summarize for us what your findings were?
Yeah, I mean, I just on a chart showed the bond yield versus the year-over-year percent change in nominal GDP, and showed that during the 1970s, when inflation took off, the bond vigilantes weren't vigilant at all. Bond yields stayed below nominal GDP, which enabled inflation to accelerate. Then in the 1980s, they realized that they had to take some charge of the situation with regards to inflation, and they kept the bond yield mostly above nominal GDP, and that helped to bring inflation down. In the 1990s, inflation came down pretty much on its own for all sorts of different reasons. Productivity made a comeback, globalization created a lot more competition, and the bond vigilantes basically went into hibernation. Really didn't hear much from them. Whenever bond yields go up significantly anywhere in the world, I get a call from a reporter asking me about bond vigilantes, and so we didn't really have bond vigilantes again until 2010, and they were in Greece when the Greek bond yield went up to 40% in the debt crisis back then. Now we've got the bond vigilantes pushing up bond yields significantly in Japan, as I mentioned, the UK, and also, as I mentioned, in 2023, we sort of had a brief sample of what could happen if things really got out of hand. But as I said, the Treasury calmed things down. They could probably do it again.
Bottom line then, do you expect nominal GDP growth to continue growing in line with bond yields rising?
Yeah, I mean, I don't think bond yields are rising. I got them at 4 to 5% for as far as the eye can see. I think we're gonna stay at normal. I think that
Okay.
I think we have a short-term inflation problem that will in fact moderate. I don't know if I'm in his camp or he's in my camp, but I agree that with the Warsh, that productivity is going to make a big comeback. Besant is in this camp as well. So they're all kind of supporting what I call the roaring 2020 scenario, and so far so good. We're 7 years into the roaring 2020s. GDP is at an all-time record high. We haven't had a recession. The stock market's at an all-time record high. I'm shooting for 8,250 on the S&P 500 by the end of the year, and 10,000 by the end of the decade. And those have been my targets for a while, and so far so good.
So, Dr. Ed, on Japan, you mentioned the potential for Treasury selling off. How justified was this move that the Treasury made last Friday? A coordinated effort to support the yen. The Japanese bought $58 billion worth of yen. It was not exactly disclosed how much the Americans bought, but I think it was speculated around the order of $5 to $10 billion. Anyway, the Americans intervened, the Treasury intervened. Do you think that was justified? The concern may be that if the yen carry trade unwinds, there could be a sell-off of U.S. Treasuries. Was that a risk?
Well, I think it was a risk, and I think Besant clearly is more privy to what's going on in global trading desks and where the risks were more serious. And I think he really judged that. I mean, the Japanese probably told them they were going to have to sell treasuries in order to support the yen, and he came back and said, "Hold on, let's talk about it to see if we can come up with some other way to do it without you having to sell your treasury." So, yeah, he's the U.S. Treasury Secretary. His number one job is to make sure that America's debt can be sold at an interest rate that is tolerable. And so I think he did what he had to do.
Bottom line is we have here an earnings season that's been strong. Today, for example, just actually yesterday, SpaceX reported revenues higher than expected, although their Capex spending was also higher than expected, which contributed to their decline in the stock market. How would you evaluate the strength of the earnings season right now?
Well, in response to the earnings season for the second quarter that we're that's will soon end. And in response to the first quarter earnings season, I coined a new term, FEMO, fabulous earnings momentum, which is distinguished from FOMO, which is fear of missing out. Fear of missing out. The stock market equation is pretty simple. It's PE times E, and the E, the earnings, I think what the market discounts, it's analyst consensus expectations for earnings. Investors don't discount their own expectation for earnings. They don't discount what I think or strategists think. We have a huge community of analysts that are doing all this work and getting paid pretty well for it. So I think what the market discounts is what analysts collectively are thinking about the earnings of their companies, and you add it all up, and then you get a consensus for the market. So the earnings number that's discounted is basically determined by industry analysts, and the PE is basically determined by investors. They decide how much they're willing to pay for the kind of earnings that is in the market or that analysts are providing. And what we've seen over the past few months is that this fabulous earnings momentum. Our earnings have been phenomenal, but investors kind of sold on the news. I mean, the earnings were so strong that the investors almost didn't believe it. So we had June and July swoon in the face of soaring earnings, and so the PE actually went down. The stock market got cheaper. The S&P 500 got cheaper. Information technology in the sector in the industry in the S&P got cheaper. So did semiconductors. And meanwhile, the analysts didn't kind of say, the stock prices came down a little bit. We're going to lower our earnings expectations there. Those earnings expectations don't change very much, certainly not to the downside unless there's a recession. And they take their lead from what the companies actually report. So that's what's driving the market up. We've got FEMO driving the market up. Earnings have been extremely strong. And then over the past few days, we've seen that a lot of people who sold the market because they had a lot of profits and they were nervous about keeping them are actually jumping back in and having more confidence that this earnings strength is sustainable. And that's been my pitch. That's been my view for a while. This roaring 2020s idea is all based on the notion that the economy is fundamentally resilient. Consumers are fundamentally resilient. Capital spending is strong. And that all this, to a large extent, is kind of predicated on a view that I've had that as the baby boomers retire, there would be a shortage of skilled labor. We would need to augment the productivity of the workers that were still in the labor market, and that there are technologies to do that, very similar to what happened in the 1920s. That back then there wasn't really labor shortages, but there was great technological innovations that increased productivity and the standard of living. And the same thing is happening now. And the reason that the market's willing to pay a relatively high PE, or let's say it's around 20 right now, for the forward valuation multiple, forward PE, is because people have come around to my view that maybe we're not going to have a recession for a while longer.
Yeah. On the earnings, how much is too much Capex? I think investors are starting to wake up to the fact that not all Capex is productive, or perhaps you're spending too much on things that aren't related to your business, as was the case with SpaceX. Yeah. I'm just using that as an example because it came out last night. They're spending a lot of money on Grok X, so AI not directly related to their rocket business. People are calling SpaceX an AI company now. The point being, the Capex build-outs for data centers and AI have largely propped up spending amongst tech companies.
Sure.
How much is too much, you think? We're not putting a number on it, but just generally, yeah.
Yeah, David, I think that's why we get this volatility in the AI trade, because sometimes investors feel comfortable with it. Then all of a sudden, some company in China comes out with a large language model that's cheaper and more easily run. And then people have second thoughts about that. And then they see that the hyperscalers continue to commit lots of capital for data centers, and so they kind of get twisted around about where this is all going. I think the AI revolution is the real deal. I think there's obviously elements of hype. There's going to be excesses. There's going to be some winners and some losers. I think what you have to do is have a diversified portfolio, as they say on Wall Street, of a lot of the companies that are likely to benefit from AI, realizing that some, maybe more than some, will not survive. But for the economy, all this capital spending is a big boost for economic growth. In terms of how much is too much, I guess it'll depend on whether we suddenly have so much excess capacity that it just isn't used. But that's not the situation that these companies are seeing. These companies are basically saying, the managers are saying, boy, we wish we had all that capacity today because we have the demand today. And so they have a tremendous amount of backlogs of demand for more capacity. Meanwhile, the cloud revenues are coming in very, very strong. So it's not as though we're just investing without any signs that this is a profitable business or that it's at least generating revenues. It's definitely generating revenues. It's kind of like the Amazon model way back when Amazon, quarter after quarter lost money. They didn't report earnings gains, they report losses because they kept investing in their business. And then after several years of doing this, you suddenly step back and say, you know what, we've achieved what we want to achieve. They were able to slow down their capital spending, and their earnings just like exploded to the upside. And I think it's probably a similar kind of situation here with the hyperscalers. They do have negative free cash flow. On the other hand, they do have very strong profits, very strong, based on very strong revenues and extraordinary profit margins for companies their sizes. And I think they're going to deliver.
I have here a chart of wages. This is from Yardeni Research. I encourage everyone to check out your website. A lot of good charts here. And just to close off the discussion, people are concerned about inflation, of course, which we talked about earlier. We can get your inflation outlook in just a bit, but people are also more concerned about whether or not their wages are going to keep up with inflation. And so when you're looking at this type of data, how would you make the evaluation whether or not real wages will continue to go up? Meaning nominal wages beating inflation. Yes.
Yeah, we actually look at a lot of charts like this. So you're looking at average hourly earnings for some of the industries that are out there.
Yeah.
And on a year-over-year basis, let's say inflation, let's say core inflation is running around 3.3%. So then you compare that to what wages are doing. And right now, wages are rising at about the same pace for overall wages. So real wages really aren't growing, and that's because inflation still is not at 2%. If it was at 2%, then we'd have an increase in real wages of basically 1%. But historically, and I'm talking basically since 1995, if you take average hourly earnings and divide it by the consumption deflator, which is a better measure of inflation than the CPI, what you find is that real wages have, on average, increased by a little over 1% per year, which compounds rather nicely, and that's what creates the increasing standard of living. And I think that after some of this turmoil we have with the tariffs and the war, I think once that's behind us and once AI really kicks in more on the productivity side and less on the cost side, right now a lot of AI components are getting more expensive and forcing consumer electronic prices to go up. But I have no, I'm not concerned about the trend of real wages. I think it's going higher.
Okay. At what point do you think higher inflation expectations will start to add a drag to aggregate demand?
Well, there are various surveys of inflationary expectations. I think I would say, some of them aren't particularly useful. Some seem to be better. I would say that we're probably looking at an expected inflation rate of about 3%. If you look at some of the surveys, if you look at the market measures, such as the spread between the bond yield and the comparable, the 10-year bond yield and the comparable TIPS yield, you get expected inflation rate of about 2.5%, which isn't really much at all, notwithstanding everything that's been happening with the oil prices. So I don't really see that expected inflation is a problem. The Fed always wants to, as always says, that they want to see that inflation expectations are well anchored, and I don't think that's a problem that they have at this point. But they don't want it to be a problem, and if they don't want it to be a problem, they may have to tighten a couple of times just to establish, raise the Fed funds rate a couple of times just to establish their credibility as being vigilant against actual inflation, and that will in turn keep inflationary expectations anchored.
Final question.
Yeah.
What do you think will be the ultimate winner in this AI trade? Would it be semiconductor chips? Would it be agentic AI companies? Would it be companies like Anthropic if they were to go public later this year? If someone were to invest in the tech trade right now, which subsectors would they look at?
Well, I think again the AI trade can make your head spin. And it's there's a lot of uncertainty about it. We don't really know how long they're going to continue to expand their databases. We don't know if in a year or two we're going to have radically different semiconductors that don't require as much electricity, don't require as much cooling, that make what we are putting in now obsolete, or making it sort of like kind of backup capacity. We don't really know all of that, but we do know that these companies are committed to spending a lot of money. So I think, the semiconductors make sense. When you get a buying opportunity in semiconductors, as we did a few months ago, when everybody concluded that AI was going to put some software out of business, I think that turned out to be a pretty good buying opportunity. I think the hyperscalers have already had a pretty decent comeback from their decline earlier this year. They've underperformed so far this year, but they seem to be making a comeback. But I think at the end of the day, I feel more comfortable, and I think we're seeing it in the market. I feel more comfortable with companies I understand. I understand their business models. They've been around for a while. They have a history of earnings and dividends. And on top of all that, they may very well benefit the most from AI. So we actually went from overweight to market weight on information technology at the end of last year, and feel pretty good about that. And we maintained our overweight on financials and industrials as the sectors most likely to benefit from all this spending. And then we added healthcare as I think we all know when you walk into a doctor or a doctor's office or a hospital how bad the productivity is, and AI could really make a big difference there.
Yeah, absolutely. Okay, thank you, Dr. Ed. Where can we follow you?
Well, we've been doing this for a while, and our website is yardeni.com, and anybody that wants to get a trial can certainly go there.
Okay, we'll put the link down below to yardeni.com.
Thank you
so much, Dr. Ed. We'll speak again soon.
You're welcome.
Thank you for watching. Please do subscribe and like and follow Dr. Ed and Yardeni Research, link down below.